Hello and welcome to GenUX. We're so happy to have you back here. Today we are talking to William Tavel, and he's going to tell us all about medical devices, funding, VC, AI, and how it affects everything that's going on in new startups. We're really excited to have him, and welcome, William.
Thank you. It's so great to be here. I love the whole GenUX team. Everything that they're doing is so incredible, and I'm excited to talk about the topic, honestly.
Awesome! I'm so excited to have you. So, William, for everybody out there in the Omniverse, why don't you tell us about yourself, your background, how you do it, your philosophy of life, all the things.
Of course. So I was born and raised in Washington, D.C., and I had the dream of becoming a mechanical engineer. I went to a technical university in Cleveland, Ohio called Case Western Reserve University, where I started studying engineering and realized that being an engineer is extremely difficult, and the people who do it are very smart. I ended up graduating with an engineering degree, but quickly pivoted into the field of business by getting a specialty master's degree called a Master's of Engineering Management. While I was doing that program, I met a really great mentor of mine named Terry Thiel, who recommended that I go into due diligence for investing. Because of that, I ended up working at a shop that did due diligence in Detroit, focusing on middle markets and industrials. After that, I moved to a group that did due diligence focusing on emerging markets work in Washington, D.C. And then I moved to working for the World Bank Group. The World Bank Group has a private investing arm called the IFC, and there I served as the data liaison for the diligence team on the health and education side. There was this minor global pandemic called COVID-19. I don't know if you all remember, but because of that, I moved back to Cleveland, Ohio to be closer to friends and family. And while I was there, I met some lovely former colleagues of mine, and they said, hey, we'd love to get some of your guidance and support at the university. And so now I serve as an advisor for the university's entrepreneurship center. And there I serve three roles. My first role is I run the Student Accelerator Program, helping students turn their businesses into investable companies. I then also work with the Tech Transfer Office through what's called the TVSF Fund in Ohio, where I advise professors making ultra innovative technology, whether or not they should commercialize, and if they commercialize, how they should commercialize. As I'm sure you can imagine, it's AI. A lot of this involves next generation technology and kind of what we'll be talking about in the rest of this chat. And then the last thing that I do is I serve as a community connector. So I get to talk with lovely people like Staci and say, hey, you're doing really cool stuff. Can I just learn more about what you do and help you out with what you do? And so that's kind of what brings me here, is I met GenUX through my lovely network, and I'm excited to talk more about the future of venture investing.
That's awesome. So let's get into it, because there's a couple of different things that I think people don't know about what it looks like to invest into a new company and how people should go about getting funding. There was this, if you're my age, there was a certain way of doing things, and I think if you're younger, there's a different way of doing things. So why don't you tell me about that journey? How do people get funding? What do they need to look out for? What are the pitfalls? What do they don't know, and what do they don't not know?
Of course. There's sort of three main things that I always think about when we talk about early stage investability. Because remember, getting an investment in a later stage, you're a very different type of company than when you're first starting out. And I'd actually point everyone to the 2016 National Bureau of Economic Research report, where venture capitalists actually were interviewed, over 1,000 of them, and they laid out the decision factors that they make when they invest. And there's a couple of things that came out of that report that still hold true today. The first is any barrier or hurdle or additional effort that you make a VC do is essentially a one-way ticket to not getting an investment. These are things like ensuring that your corporate governance is above board, that you have something like insurance, that you make sure that all of your employees, whether they're volunteered or not, have signed employment contracts, that you make sure all of your advisors are on your cap table. And if they're not on your cap table, you're explaining why they aren't on your cap table. All of these concepts just need to be buttoned up before you even consider funding. The second thing that we see is that venture capitalists bet first and foremost on a team. And I use the word team very specifically because it is not the founder. We have heard and we have seen time and time again that you do not bet on the founder, you bet on the team. And so there's this kind of common saying in investing, you bet on the jockey, not the horse. But what I say is it's actually more of like a Formula One team where you're not investing in the driver or the car, you're investing in all of the engineers behind the car that are actually building it.
Is that new, or is that why is that? That's interesting.
No, actually, it's not that new. We saw it even before the boom of AI and before the dot-com bubble. One of the things that has been a pretty common thing is that companies are made up of people, and happy, hardworking, professional people are what build good companies. And then the last thing that we've seen is that it's really about ensuring you have expertise. Any founder or any core team for that matter that acts like they can do it all is never one you want to collaborate with. Instead, if they need human factor or user experience work, they need to go to someone like you, Staci. If they need regulatory support, they need to go to someone like CS Life Sciences. If they need, pipeline and development support, they need to go to someone like Project MedTech.
Right.
All of these things are people that have developed decades of work experience. And they are what really help shepherd companies to success.
Now, is that based on just the things that you've seen, or is that based on just, I'm assuming this is not just based on opinion, but can you give some examples?
Yeah, there's sort of three different kind of tiers you can take. The first tier you can take is you can say, let's actually look at the data overall for all venture investing. And what you see is that the more complex the device, when you go up device class, there is actually a higher likelihood of success because there is more likely to have other people being drawn in because things get more complicated and more difficult and have longer timelines, which means that there's greater opportunity for risk, which means you as the founder need to do more to mitigate the risk. The sort of second layer that you see is you can actually just see it person to person in the community where you want your medical device to be successful. Well, you need to get it installed in a hospital as part of an innovation project. Well, do you have all the contacts for the hospitals? No, but you know what? That regulator or that human factors expert or that business development planner, they know the hospitals. They can obviously help you with that. That's what they're designed to do. That's their job. And you see that at lovely events that are hosted by med device specialists everywhere, that hospitals clamor to attend these events. They want to see what these companies that are actually shepherding the best of the best are bringing. And then the last thing that I can say anecdotally, just from my own personal work, is companies that have founders that understand all of the different complexities and really focus on bringing in subject matter expertise tend to be able to get more done with less. And what I mean to say is you would think, hey, you're talking about all these consultants, they're very expensive. Yes, pay once, cry once.
That's great. So in the landscape of getting funding for a company, have you seen anything in the last 10 years of your experience change for how people get funding, how funding is working? Is it easier to get funding? Is it harder to get funding? Those types of topics for anybody who's out there who wants to know.
Fantastic question. The landscape cannot have shifted more in the past 10 years. I think throughout my career, I joined as the inflection was happening. Mm-hmm. And so, of course, I cannot comment for the old guard. I would never try to do so. But, before the advent of generative AI, diligence reports were built by teams of 10, 15 people. There was usually a financial analyst, a market analyst like myself. There was then usually a regulatory specialist. Then there was also usually some sort of dedicated economics and policy expert for things like this. And then there's all these other finance people that are just focusing on the transaction side of the deal. I can now type this into ChatGPT and get 60% of the work done in about 30 seconds.
That's amazing.
This shift has meant a couple of things. The first is that investors are cutting bigger and bigger tickets earlier. And what that really means is that the competitive space for pre-seed investment is actually getting more and more competitive, and you're being expected to generate more and more with less. Because essentially, I am now put in this position as someone on the diligence side that says, well, if I can write this report this quickly, why can you not do X so quickly? I think one of the things that this is starting to unveil is that the cycle of innovation is increasing faster and faster. And yes, there are regulatory and investing and risk kind of things that we can discuss. But what we're really seeing is that you need to rely more and more and more on actual innovation and technical rigor. If you're just building another AI skin, your company may make it through a first round of funding and then it'll collapse. If you build an actually designed tool that is genuinely innovative, you can actually get that funding deployed earlier and grow faster and cycle out to the next sort of level of innovation in that space even faster.
That's interesting. So like thinking about, I love that you're bringing up AI, because AI is a really big topic right now. And I think that AI has taken the front seat of tech, but also there's like medical people that are trying to use AI, and there's tech that are trying to use AI, and then there's AI just as an industry in and of itself. I don't know if it's going to turn itself into its own industry, but there are definite, I would say, like when you were talking about how people are utilizing AI and potentially even how they're funding projects really has to do with like the review cycle, how quickly you can get it done, wearing more hats. Like, so when we think about across industries, are certain things getting more funding than others? Is it because of like, you were talking about the speed as to which things can get done? Is that an imposing factor? What do you think?
Absolutely. So I can comment on like how funding is being deployed in different sectors, but what I'd really recommend is that there are lovely people like JPM and PitchBook and Crunchbase that regularly sort of post all of these metrics, and it's changing every quarter. So what I say today will not hold true a year from now. It won't hold true a quarter from now. But there are sort of two big things that I see when we talk about AI in the investing landscape. The first is that this term AI, artificial intelligence, is unfortunately sort of a misnomer because it's an umbrella term. A large language model like ChatGPT is fundamentally extremely different from a well-designed multi-factor neural network.
Agreed.
One of them is a method of doing computation, and it is literally how we are doing things like image processing, where if you look in the field of like medical device and medical technology, like radiology is being totally transformed by AI, and the entire industry will never look the same. People are more accurate than ever, their images are being processed faster than ever, and there is always a human in the loop because of sort of the medical field that it exists in. And that is so fundamentally different from something like ChatGPT. And so I want to just caution listeners that when I continue to talk about AI, know that a lot of the things that I get excited about are the nerdy, boring, computational types of AI. It is not, hey, we are going to create this like artificial therapist. That is not really where I see the industry going anytime soon. And here is why. You brought up like what's going on with sectors in AI. The sectors that are really winning in AI truly are one of two things, where it is totally unregulated and is the wild, wild west, or it is actually a quite regulated sector. And so we look at things like aerospace, med device, energy. These are spaces where getting lots and lots of incremental gains can actually have huge outcomes for companies. So things like a perfect example is if I can increase patient throughput of an imaging device by 1%, that means that I can get that much more money out of that device. That means I get that much more uptime. That means I see that many more patients. I've reduced my wait times. My patients are happier. My physicians are getting more work to do. And now all of a sudden, that 1% has cascaded into a huge economic impact.
Right.
And the real thing is it's because it's being defended by this very well-regulated and monitored sector like med device, where the AI has to work. It's not that it has to work most of the time, it has to work all of the time. And if it doesn't work all of the time, it won't get deployed. And seeing that is really where we're seeing a lot of the innovations in these sectors.
That's really cool. We were, my team and I were talking about AI and language models, and you touched on such a strong point with AI. It's not a neuroconnector that can have a conversation like we're having. We process a lot of information in our brains, and ChatGPT is a predictive language model, meaning it's predicting the next word. It's predicting the next word that should be there. It can proofread things really well. It can get and organize a lot of data that's accessible to the system and bring it to you. But it doesn't think. And people, I think, do get that very disconnected. Right now, we don't have a lot of language models don't think. Let's just put it out there. They're not programmed. That's not what it does, right? So what you're talking about is something that could predict something in a capacity. So like say, you mentioned radiology, or we could even go even further and say maybe somebody's getting some kind of scope through the mouth, and they're looking for something in the stomach, right? And like maybe the system can say, oh, I see this thing. Maybe the human didn't see it, but the system did. And so that could be where this is going, predicting that there is like an ulcer in the, in your throat or something like that. I don't want to get too technical with terms, but like that type of thing. So it sounds like if it's like super regulated in a place like medical like that, that's a really good application for something, for the device itself being able to identify something. And then I don't know what unregulated AI would be like. I don't even know what the Wild West of AI looks like, but I find that interesting. Do you want to touch a little bit on like people, when they think about AI, I think there's the two forms of thought. One is Terminator and one is helpful. So, and I think a lot more people probably fall into the Terminator category than thinking AI's, like, oh, it's going to take my job away. Oh my God, machines are going to take over the world.
Absolutely.
We're going to become batteries for the machines. Should people be aware and scared, like, or should they just like look at it like it's a tool?
I think that's a really, really great question. And I think there's a couple of different contextual points before I answer. The first is that a lot of people think AI came out 3 or 4 years ago. ChatGPT came out and all of a sudden it was here. Mm-hmm. Artificial intelligence and the concept of computational systems making their own decisions has been around since, I think, the 80s, maybe even
machine
earlier.
Learning and algorithms, yes, we know. But now they're just branding it very differently. But, Yeah.
And so I think just reminding people that like this is just the next iteration. If you have been in the world of computer science, we have already been seeing things like this. Think about how long people have been trying to work on self-driving cars. It's been an endeavor since the car was invented, it feels like.
Yeah.
And so really just remembering that that's sort of the landscape that we started. Mm-hmm. And then I think the second thing is understanding kind of how Hooke's law and increased computational demand is having an impact on the use of artificial intelligence, which is effectively we're getting computers that are stronger and stronger and stronger. And so they can do more. And if something can do more, why wouldn't you let it? And so here's what I say is like there are the benevolent AI believers and there are truly the Terminator believers. And I don't really fall into a camp. Okay. AI is just like any other tool, and it needs to be used responsibly and appropriately and ethically. And as long as that happens, then it will continue to create amazing things. And we see time and time again that regulated sectors that ensure that things are being done ethically and responsibly, we see great innovations with the use of AI. And healthcare devices are obviously my like bread and butter in this space, but we see it in lots of different things. One of the things we've seen it in is energy pricing and sort of grid management. And it's had huge impacts on the space. Now, that being said, there are also people that are using AI to select job candidates. I don't really know how I feel about that. That doesn't necessarily feel like an ethical and responsible use of the tool. But between you and me, they were probably doing something very similar in a very automated fashion before this. And it was probably just called filtering, or it was called, required criteria, or whatever language you want to use. But I truly believe that it is just a tool. And it's a very powerful tool that needs to be used carefully. But as long as it is used ethically, it can have incredible potential for the world.
So You said something, you mentioned it twice actually when we were talking about finances and how if you really want to get funding, you need to utilize AI as a tool because it can give you all this information so much quicker. So even though sometimes AI works the way you want it to, and sometimes it doesn't, why are people using AI to support those financial modeling pieces to give to investors when it can also be seen as also not being able to achieve those tasks if asked to do something a certain way? And it just spits out what you're asking it to do. So what is your thought on that? And how, I feel like the funding cycle, and we kind of talked about this between you and me a long time ago, but you kind of were telling me the funding cycle is much shorter. And people and you also mentioned just before that people are just getting in there earlier and really offering quite a bit of money up front for some of these AI projects, depending on where they are in this space. So when it comes to all that, and we're talking about modeling, and you're giving information to investors who are going to invest in your company, and you might be using AI, what happens there? I know we're talking about ethical and responsible using, but what if you give, someone who's funding you wrong information, but you're still relying heavily on this tool?
Absolutely. So I think you brought up two really good questions. The first is, if I'm talking about these diligence shops and these VC firms using AI to build their PPM, to build their investment memos, to, dare I say, even sometimes build their diligence reports. Why is it that when they receive a financial model made by a startup that is clearly made with AI, is it, whoa, why are you using AI to build this model, huh? Can you not do the work yourself? Well, there's sort of two different ways to consider this. The first is that when you're an early stage company building a financial model, the reality is between 33 and 66% of it is crystal ball gazing. You don't know what's going to happen. You don't know that you're going to get these sales. You don't know that you can acquire this material for this price. You don't know that inflation is going to remain at 2% year on year. But we have to make some regular assumptions. Mm-hmm. We can't leave everything open for interpretation, or it wouldn't be a model. It wouldn't be a projection of the future.
Right.
And so when you see people use AI to build these sort of underlying templates or structures of financial models, I actually find they look pretty good. I'm actually pretty happy with the way they turn out. Okay. The thing that I fear or that causes problems is when all of a sudden you see someone where they decide to price their product at $7.91. And you're like, hey, well, can you show me all of the data that you used? Because you probably just took an average of a whole bunch of different prices and came to that. And they say, oh, well, actually, I kind of just picked it out of thin air. Mm-hmm. And you're like, sure you did. And so what we see is sort of this push and pull that's going on in the community of how much do you want founders to use these tools to plug holes and competencies that they don't have, and how much do you want them to really be able to learn and deploy these skills? And what I have kind of come to the conclusion of is if on your team you have someone that has expertise in that field, it should be the expectation that they are developing your content. So, for example, let's say you have a regulatory specialist on your team. Your regulatory pathway should be built by that person. If you have a CFO on your team, they should build the financial model.
Right.
You know what the reality of a lot of med device companies is? They can't afford a CFO in the beginning. No. They don't have that money and they don't have that bandwidth. And so, look, if you need to sort of get some support from these advanced tools because you don't have the human expertise, that's great. The decision point is when you put computer expertise over human expertise. That's really where things fall apart. And then the other thing you were talking about is funding cycles.
Yes.
And so much to say.
Okay, let's go.
Funding cycles are getting faster and faster, and the clearest thing you can see right now is in the secondaries market. People are looking to invest and then also withdraw capital as quickly as possible and increase essentially their cash cycles.
So hold on, let me just ask you. What is a secondary market? I don't think I know what that means.
Yeah, exactly. Most people, when they think about an investment, the way you exit that investment is the company either IPOs and you're selling your ownership to the general public, or some company like Stryker or any other major medical, or Philips or GE comes and buys you for hundreds of millions of dollars. Well, what if you're a VC fund and you kind of want your money back and the company is doing well? They've gotten through their regulatory approval, they're getting some sales. You can say to other investors, hey, I have the ownership in this company. It's doing really well. It seems like it's going to exit probably. You're going to get a great return. I kind of just need some cash right now.
Okay.
And so you can sell your share on a secondary market where it's not actually with the original company, it's just between you and another investment firm. And you're just transferring your ownership with a sale. And we're seeing more and more of that activity every year.
Oh.
And so really what we're seeing is that it's being driven more on gut reaction, more on big bets, more on unicorns, more on faster cash cycles. And so what we're starting to see is, if I can get 100 different investments in and one of them lands, I'm good. My fund will return. The concept of slow, steady organic growth in the healthcare space is becoming not a rarity, but less and less common.
That's interesting. I didn't know that. So do you think, in 2008, there was a big bubble with, tech, and everybody was funding tech, and then all of a sudden, I lived in California at the time, there was the Silicon Valley bubble, and it burst in 2008. Do you think that with what you just said, people investing faster with gut reactions, do you think we're going to see a situation like that with VC firms that are investing just not necessarily on really great data, but just on gut instincts in some of these industries that we're talking about?
So this actually takes us all the way back to our beginning question we posed, which is what are the things that companies think about when they want to invest?
Yeah.
And I said the biggest decision is the team. However, I actually held back an important statistic. That's only the plurality of the decision, and it's about 40%. So that means the majority of the decision is done by product and process. And so what I am crystal ball gazing myself, I'm not going to say that I can read the future, but I'll sure try, is that all of these small specialty firms will continue to thrive because they thrive on industry expertise. I was a physician that invested money with a financial colleague of mine. I built a company that then opened an investing arm. All of these types of small strategic funds will continue to perform. And the reason they will continue to perform is because they look at all three things: people, product, and process. However, I do believe that as time goes on, we will start to see that these funds that are relying on recycling capital as quickly as possible will start to hit hiccups. I do not think this will result in a full financial collapse like 2008. Mm-hmm. But what I do think there will be is there will be a fundamental redistribution of how people think about deploying capital. And what I think we will see sort of that this period of about 10, 15 years was a really interesting experiment, but we will move towards a more normalized structure where the earlier stage investments are run by smaller companies that are more targeted and it can provide more of that tangible support. And then as you get bigger, then you can start working with things like PE and institutionals that have those larger 100, 150 person teams that can really build out a large scale investment. And I do think that transition will be painful for a lot of people. These multi-$100 million VC funds, there will be real disruption. I don't know what will come out of it, but I am curious to see what happens over the next 5 years.
I would agree with you. So here's a question that I don't really know the answer to. So when these VC firms are investing in any of these types of businesses that they think, the PPPs, PPE that you were saying, what happens when those businesses fail and they don't get their money out of it? What goes on then?
This is something that I think a lot of people don't want to talk about because they always want their startup to be the unicorn. They always want their startup to be the one that does it. Every single person believes they're the king of their own castle. There's sort of the reality of what happens, and then there's what people say happens. What people say happens is, things didn't work out. company folded, and we're all on to our next project. It'll be what it'll be. The reality is many of these companies have assets. Many of these companies have intellectual property that has value. Many of these companies have access to perhaps proprietary or sensitive information that could be useful for other companies in the portfolio. And so the thing that can happen is it can essentially turn into a feeding frenzy where it's how do I try and recoup any of my losses possible? You have this machine that does this testing and I can sell it used for $3,000. Great. Like that's $3,000 that I get back that I wasn't getting back before.
Right.
And then there's the other side of, oh, can I take these people? Can I take the CEO that maybe is a fantastic leader and just didn't nail it on the actual product and start deploying some of these other assets that the company has, either real or kind of just like intangible assets, and deploy them into another portco? And this sort of transition period when these companies are shutting down can not only be a tricky road, but can also create a lot of opportunity. It can create growth for another portfolio company if there's potential synergies. It can create potential employment opportunities for those people that were in roles at that closing company and are now, essentially on the market. And then the other thing is all of these VC firms that are above board and work hard will conduct postmortems and say, what went wrong? Where did we screw up? Well, something fundamentally did not go well. And what you can see is you can see some VCs because of that will essentially blackball things, saying we made an investment in orthopedics and it did not go well. And so, you know what? We're not touching orthopedics anymore.
Right.
Or, we made an investment in healthcare AI and it was a regulatory and ethical disaster. And so we're just not doing it anymore. And all of a sudden that fear can permeate not only through other potential portcos that may be in those sectors because of previous investments, but also that fear can start to permeate into other VC firms and the general investing community. Because when companies fail like this or businesses fail like this, everybody knows. It's not a secret. There was a guy or a girl who was CEO of something and now they're not. Like, we all know. And so all of a sudden, if you start hearing, oh, investment company A is no longer investing in medical device, whoa, what on earth went wrong? And so then what started off as a fight over a $3,000 machine all of a sudden can turn into PR issues and managing expectations within the investing community and talking and assuring your other portcos that you believe in them. And this concept is very not well understood in the industry, and it's something that I am personally very interested in exploring more.
So I have two follow-up questions. So I'm going to ask them, well, I'll ask one first and then the end will be the
Of course.
part. So if you were to give any advice to anybody who's in any startup business, who's looking for, venture capital, what would you tell them? You gave some good advice in the beginning, but based on, the whole conversation that we've had and what could happen at the end, what advice would you give them to cover themselves, make sure that they're in good standing?
Yeah, as I said before, ensure your cap table is tight. You've done modeling on dilution. You understand your ownership structures, all that jazz. But really, guidance for fundraising. It comes down to three things that are all very simple. The first is fundraising is a full-time job. When you start fundraising as a CEO, you have two jobs. You are CEO and head of fundraising. Know that it is a long, hard, painful slog. And if it's not something you're ready for, know that you do not need to fundraise. That is my second piece of advice. No company needs to fundraise. You can bootstrap. You can get grants. You can get non-dilutive funding. You can get partnerships. You can get early sales. Those are all options to inject capital into your business that isn't taking an investment.
Right.
So my second piece of advice is you don't always have to fundraise. And then my third piece of advice is if you are ever the smartest person in the room as a founder, you are in the wrong room. Just like
totally agree with that. Yeah, I hire people that are smarter than me, or at least I think they are.
Is I mean, it is the cornerstone of what I believe makes fundraising successful is when a potential investor asks a CEO about their financial model, the CEO says, I'm gonna stop you right there. Love the question. You need to ask my CFO. He's the one who builds it. If I try to opine on it, I will probably say something wrong. And that doesn't mean to say that the CEO couldn't do it, it's that the CFO will do a better job. And so know that your team is there to help you.
Mm-hmm.
Your team is there to make sure that the fundraise is successful. And so always make sure that you are never the smartest person in the room.
I love that advice. I think that's great advice. Myself as a business owner, I'm a bootstrapper. That's my philosophy. I think that you can do it on your own, and slow and steady organic growth is my jam. And it's interesting to me. It might just be because I come from a different generation, or like my perspective's different, but I know a lot of people who are startups who do a ton of fundraising, and that's how they get money and raise capital. And I just am like, wow, that's really cool. And sometimes I'm like, should I be doing that? And I'm like, yeah, no, I'm making money year over year. I'm showing profit. So that's always a good thing. So I'm doing the right things. I don't know how I'm doing them the right way, but I know that they're the right ways. It's kind of just philosophies, right? Like you were saying, like I could get a grant if I needed to. There's tons of business grants out in the government. We are certified women-owned small business with the government. So, I mean, there's definitely things that I could do if I wanted or needed to go down that route. Right now, probably not the best time because we're during, I don't know when this is going to air, but right now we're in a government shutdown. So I can't really ask the government for money, for funding. But they do offer a lot of funding. So I agree with you. There's definitely ways of raising capital without going through VC. So,
Absolutely.
William, if someone was interested in asking you questions or working with you, how can they find you? Where do they go? Tell us where's the whys of you.
The first thing that I will say is I am so grateful to work for a higher educational institution that believes in mentorship. My time through Case Western is totally free of charge to anybody in the entrepreneurial community. You can email me at william.tavel@case.edu, case.edu, and you can email me and say, hey, I have a startup and I want to get some guidance. I want to get your opinion. I just need to bounce something off the wall. I'm here to help. I also run a consulting firm that helps with investor relations, helps with strategy, and helps with kind of also fund development and fund execution. That company is called Cassandra Consulting Group. You can email me again at william.tavel@cassandraconsultinggroup.com. And then I also have the distinct pleasure of working for a venture studio as head of due diligence called Encore Venture Labs. And they kind of work on using private equity to acquire industrial facilities and use them as test beds for new innovative companies. And if you're at all interested in kind of understanding what that type of investment and partnership looks like, you can email me at william@encoreventurelabs.com. And if for some reason any of those emails don't work, I will also tell everyone that you can always reach out to me on my phone number, which is 301-910-9648. And I take a phone call from anyone. You call, I answer. That's my motto.
And you're also on LinkedIn, and that people can get you on LinkedIn too.
Yeah, you'll find me before I find you, I have a feeling. Just feel free to add me on LinkedIn. I'm very active. I answer almost every day.
So we'll have all that also at the bottom. If you scroll down to the bottom of this video, and you will see all the information you can about William. William has also been someone that we are probably going to work with in the future. We think that he's pretty awesome here at GenUX, and like he said, we found each other through our mutual networks. So definitely, I want to add to what William's saying, network. If you're a small business owner and you're looking for people like William to be engaged with you, that's the best way, and it's the one way to find people that are going to suit your needs and that you like. That's the best way to do it, is through networking.
We're all here to help.
Yeah. William, thank you so much for joining us today on GenUX, our Intrinsic Data series, and you have a lot of new trends coming out of the VC sector of funding companies. Thank you so much.
Thank you. I hope you have a great rest of your day.
You too.